If you're self-employed in Alberta and you've been told you're pre-approved, that does not mean your mortgage is actually safe. And that's exactly why so many self-employed buyers get blindsided. They hear you should be good, and then they start looking at homes, sending listings to their partner, they start picturing their couch, where it's gonna go, and then all of a sudden, the deal falls apart. And it's never at the beginning, it's always at the worst time possible. After they're emotionally invested, after they've made plans. And the craziest part is, most of the time, the reason the deal falls apart is not because the buyer was unmortgageable. It's because nobody actually looked at the file the way the lender was eventually going to look at it. See, that's the trap right there, because a lot of self-employed pre-approvals are way too shallow. They're based on rough income, quick credit, surface level debt, incomplete documents, and a whole lot of other assumptions. So the buyer walks away feeling confident, but the file was never actually strong. It just hadn't been properly tested yet. By the way, my name is Ushindi Mutabazi, also known as the Self-Employed Mortgage Guy. I am a mortgage associate here in Alberta, and I specialize in helping self-employed Albertans like yourself qualify for a mortgage without waiting for the 2-year income averages, paying more in taxes, or changing the way that you run your business. In this video, I'm going to be showing you exactly why so many so-called pre-approvals end up falling apart. I'm going to go over what lenders are really looking at behind the scenes and what has to be cleaned up before you begin shopping so you don't waste your time, lose any deals, or get hit with any last-minute surprises. Let's start with the biggest and the most common problem when it comes to self-employed buyers: the income. The lender is never qualifying you based on what it feels like you make. They're qualifying you based on what they can actually see on paper. And those two numbers are often very different. If you're a sole proprietor, that usually means they're starting with your net income. And if you're incorporated, they usually focus much more on what you actually pay yourself. So you might feel and act like a 200K per year earner, but if their paperwork only says 70K per year, that 70K is what you're being qualified on. And once that income qualifying number changes, everything else changes with it. Your budget changes, your options, your strategy, and this is exactly where the next problem starts. Once your income number comes in lower than expected, the next mistake is trying to force the file into the cheapest lane instead of the right one. Not every self-employed borrower fits into the same mortgage lane. Some files are strong enough for prime lenders, but some need an alternative route. And the mistake is when someone looks at your situation and says, let's just try the bank, without really asking and dissecting whether your file actually fits in that lane. Prime lenders usually want a cleaner story, cleaner income, cleaner paperwork, and if your file doesn't naturally fit that lane, trying to force it there can waste weeks and give you confidence that you never should have had in the first place. And that's why so many self-employed buyers feel confused. Instead of just being told no right away, they're being told maybe in a way that sounds like a yes. And that false confidence is very dangerous because now you're shopping with the wrong expectations. And the worst part is, even if you get matched to the right lender, that doesn't necessarily mean the deal is now safe. Because the next place these files fall apart is when lenders stop listening to your story and start looking at the proof. Before we keep going, if you're self-employed and planning to buy in Alberta within the next 6 to 12 months, click the first link in the description and complete my 3-minute mortgage readiness quiz. One of the biggest reasons people never end up buying is because they never feel ready, and most of the time they have no idea how close they actually are. So I want to help you out and provide some clarity. Once you complete that quiz, I will personally record you a custom video within 24 hours breaking down your numbers, explaining exactly how a lender would likely view your file, and laying out a clear approval strategy based on your current situation and your goals. This quiz is not a mortgage application. I will not be pulling your credit. This is just a chance to get some answers and get one step closer to buying your home. Let's get back to the video. In mortgages, numbers don't mean anything if the paperwork doesn't back them up in the way the lender can approve. And this is the part most people underestimate. They think, I make good money, I'm a 200K per year earner, so I should be fine. But for the lender, it's not enough for the income to exist. It has to be clear and it has to be consistent. That means your tax returns, notice of assessments, proof of business ownership, bank statements, and down payments, all these documents have to tell the same story. The moment one document says one thing and another says something different, the lender starts getting nervous. And when lenders get nervous, it's not good for anyone. The conditions get tighter, they ask more questions, there's more delays, and more chances for the deal to fall apart. This is also where a lot of self-employed buyers get hit with surprises they didn't initially think mattered. And it could be the smallest things: your CRA balance, unfiled taxes, messy down payment trails, things that you would assume should be minor suddenly become the reason your file slows down and things start slipping. It's not always about whether you earn enough. It's about whether the file feels clean and looks good enough to trust. And once the lender has the full paper trail in front of them, that's when the next layer shows up. Now they stop asking, can this person qualify? And instead they start asking, can this person actually carry this mortgage without stretching themselves too thin? Even if the income works and the paperwork is clean, the file can still fall apart if your debts weren't properly accounted for the first time around. This is where lenders start looking at your GDS and your TDS. Your GDS, or your gross debt service ratio, is your housing cost as a percentage of your gross income. That means your mortgage payments, your property taxes, the heating, and usually half of your condo fees if there are any. And then your TDS, or total debt service ratio, adds in all your other monthly expenses on top of the housing expenses. That means car loans, lines of credit, credit cards, personal loans, and anything else, even alimony or child support, that carries a monthly balance. So if your gross monthly income is $5,000 per month and your total monthly housing costs plus other debt payments add up to about $2,500, then that would put your TDS ratio at 50%. This matters because for files with a down payment lower than 20%, most lenders want to see a GDS ratio under 39% and a TDS ratio under 44%. Once the lender has confirmed your debts and your monthly expenses, you are now one step closer to actually getting approved. But I've seen people during the approval process do something that makes their file even harder to defend. And that's because once people hear pre-approved, they often think the job is done. They move money around, they take on new debt, they might even change how they pay themselves. And they assume none of it matters, it's all minor, because they already got pre-approved. They think they have the green light. But for self-employed files specifically, that is very dangerous. Your bank activity already has more moving parts than a regular salaried borrower. So the last thing you want to do is make the file harder to understand, especially when the lender is still reviewing it. From your perspective, it might be something pretty minimal, but from the lender's perspective, the income looks different, the paper trail is now messier, the cash feels tighter, and now the file feels riskier. And that's when a deal that looks fine 2 weeks ago suddenly begins to fall apart. When a self-employed pre-approval collapses, it usually isn't random. Most of the time, it's usually because the file was never strong enough to begin with, and then something happened during the process that exposed it. So if you're self-employed and you're looking to buy in the next 6 to 12 months, don't just ask, can I get pre-approved? You should be asking yourself, if the lender saw my full file today, would it actually hold up? And can I stay put during the whole process without changing anything if it isn't broken? Answering those two very critical questions can save you a lot of time, a lot of stress, and in some cases, a deal you were never truly ready for in the first place. But the first thing that you need to do if you're looking to buy a home in the next 6 to 12 months is click the first link in the description and complete my 3-minute mortgage readiness quiz. Once you complete that quiz, I will personally record you a custom video within 24 hours, breaking down your real numbers, explaining exactly how a lender would likely view your file, and laying out a clear approval strategy based on your timeline, your goals, and your documents. That way you get a pre-approval that you can actually trust. And make sure to follow me on Instagram at Self-Employed Mortgage Guy. Link for that will be in the description as well. If you have any questions or just want to chat, you can message me on there.